Welcome back to Talk Tickers. This is the show where we strip out the fluff, we ignore the PR spin, and we get straight to the numbers that actually move the market.
If you are listening to this, you care about alpha, you care about execution, and you care about the ticker.
I'm your host, and today we are breaking down a massive print from a company that, let's be honest, many people wrote off a decade ago.
It is Thursday, January 29th, 2026, and I have to say, the market is waking up to a very different landscape this morning. The quote-unquote dinosaur is dancing.
We are talking about Big Blue IBM International Business Machines. The earnings call wrapped up yesterday evening, and I want to start right at the finish line. We have to address the stock action immediately.
We have to. It's absolutely ripping.
It closed yesterday around, what, $294?
Yep, $294. And in after-hours trading, it just surged. We saw a jump of about $19.50.
So we are hovering right around the $340 mark. That's a 6.6% move. For a company this size, that is just massive.
It is huge. And for a low beta, high dividend stock like IBM, that is effectively a breakout. You know, you have to remember the options market was only pricing in a move of maybe 5.4%.
So it beat the implied volatility.
It beat the implied volatility. It tells you the street was caught completely off guard by the quality of this report.
I want to dig into that word quality. Because usually when I think of IBM, I think of Grandpa Tech, I think of a safe dividend, maybe flat growth.
Right.
But the thesis we're looking at today is something different. We're calling this the durable incumbent. The stock didn't just jump because they made a little more money. This feels like a structural change.
It is. It's the concept of a mix shift. I mean, IBM has been claiming for years that they are pivoting to a software-led hybrid cloud and AI platform company.
Right, but that was just a slide in a PowerPoint deck for a long time.
Exactly. For a long time, it was just talk. What we saw last night was them proving it with cash.
Okay, let's look at the receipt for that claim. Let's hit the headline numbers first. The results snapshot.
Let's do it.
Revenue came in at $19.7 billion. That's up 12% year over year.
Or plus 9% in constant currency. But that top line, the street was looking for roughly $19.2 billion.
So they beat by $500 million. That's a solid beat.
It's a very solid beat. And you have to put that in context. We are in a macro environment where every CIO is talking about selective spending. Budgets are tight.
Very tight.
For a legacy player to grow revenue 12% in that environment, that signals they aren't just maintaining share, they are taking it.
And the bottom line looked even better. Operating non-GAAP EPS came in at $4.52.
And the consensus was sitting at what, $4.31?
Yeah, $4.31, so $1.21. GAAP EPS was even higher at $5.86. But here's the number that I think really got the bulls excited. I'm calling this the mic drop number for the quarter.
Free cash flow.
Free cash flow. For the full fiscal year 2025, FCF hit $14.7 billion.
Let's pause on that for a second. $14.7 billion. That is the highest level of cash generation IBM has produced in over a decade. This is crucial because for years, the bear case on IBM was that their cash flow quality was degrading. Critics said, you know, they were using financial engineering or delaying payments.
By propping it up.
This $14.7 billion, this is driven by real operational improvements. This is real money.
And it seems like that money is coming from better efficiency, right? Because the margins expanded significantly.
Hugely. We're looking at 60.6% on a GAAP basis and 61.8% on an operating basis.
And didn't the CFO say this was a record?
He did. Jim Kavanaugh mentioned on the call that this is the highest operating gross margin in their reported history.
Okay, so this is where the story shifts from a turnaround to pure execution.
That's it. When you see margins hitting historic highs while revenue is growing at 12%, that tells you the underlying business mix has fundamentally changed. They're not just selling low-margin boxes anymore.
They're selling high-margin software.
And specialized infrastructure. That mix shift is the engine here.
So let's unpack that engine. This brings us to Deep Dive Part 1, the software engine. Management has been shouting from the rooftops that they are software-led.
And the numbers are finally backing it up. The software segment revenue clocked in at $9.0 billion for the quarter, up 14%.
14%. Is that a record too?
That is the highest annual growth rate for software in IBM's history. And think about the scale of that. This isn't some startup doubling off a small base.
No, this is a $9 billion quarterly business.
Growing at 14%, that is incredibly difficult to do.
So let's break down what's inside that number. Data and AI was up 19%.
19. That's the Watson X validation.
Automation? up 14%. We know HashiCorp is in there. Red Hat was up 8%. And even the legacy stuff, transaction processing, was up 4%.
You know, the data and AI number at 19% is the real standout for me. But I want to touch on Red Hat for a second, because I think some listeners might see 8% growth and think it sounds a little soft.
It does seem a little lower than the others.
Yeah. Right. And management was honest about that. Bookings were in the single digits. They explicitly called out the U.S. federal government shutdown as a headwind.
Ah, okay. That makes sense.
When you sell heavily to the government and the government turns the lights off for a few weeks, your bookings are going to take a hit.
Kavanaugh was pretty clear on that. But what about the annual recurring revenue for OpenShift? That's their Kubernetes platform.
Right. OpenShift. That's now at $1.9 billion. And it's growing over 30%.
Can you explain for the listener why OpenShift specifically matters so much? Why do we care about that one product?
Sure. Think of OpenShift as the operating system for the hybrid cloud. If a company wants to build an app that can run on AWS, Azure, and their own private data center without rewriting the code,
they build it on OpenShift.
They build it on OpenShift. And once you do that, it's very hard to leave. That's sticky revenue. So if that's growing at 30%, it means enterprises are locking themselves into the Red Hat ecosystem for the long haul.
It's the anchor.
Exactly. And to loop back to why margins are at record highs, it's because software is now about 45% of the total business.
And software has insane margins.
Once you write the code, selling another copy costs almost nothing. So when nearly half your revenue comes from that, the profit profile of the entire company lifts. That is the flywheel effect Arvind Krishna keeps talking about.
Okay, so software is booming. But here's where it gets really interesting to me. We always hear that hardware is dead or that the mainframe is a dinosaur.
Right.
But Deep Dive Part 2 is all about the mainframe supercycle. Infrastructure revenue was up 21%.
21% growth. In hardware. In this environment, it's just unheard of for legacy infrastructure.
And it was driven by the IBM Z17 mainframe. IBM Z revenue specifically was up 67% in the quarter.
67%.
67.
This is the Z17 cycle in full swing. Yep. But listeners need to understand why companies are buying mainframes in 2026. It's not just to run old bank transactions anymore.
The narrative has changed.
It has. It's about AI inferencing.
I'm glad you brought that up because management made a huge point of this. They said the Z17 processes 50% more AI inferencing operations per day than the Z16. They even name-dropped CVS as a client.
Yeah.
But I want to clarify something for the audience. What's the difference between this and what NVIDIA does? Why aren't they just buying H100s?
That is the critical distinction. When we talk about NVIDIA H100s, we're usually talking about AI training, taking a massive data set and teaching a model.
Right, that's the heavy lifting.
That requires huge compute, usually in a public cloud. But AI inferencing is when the model actually does the work. It's when it scores a credit card transaction for fraud or analyzes a medical claim.
So training is going to medical school and inferencing is actually performing the surgery.
That's a great analogy. And here's the kicker. Inferencing happens in real time. If you swipe your credit card, you can't wait 2 seconds for that data to travel to a cloud server and back.
You need it approved in milliseconds.
Yeah, exactly. And since that transactional data already lives on the mainframe, moving it adds latency and risk. The Z17 lets you run the AI right where the data lives.
So they're bringing the AI to the data rather than sending the data to the AI.
Precisely. And that connects perfectly to what CEO Arvind Krishna said about the future of AI. He dropped a prediction that I think is the core of the bull thesis.
Which was?
He believes 50% of enterprise AI will be private or on-premise.
That is a bold call when everyone else is shouting cloud first. This is the sovereignty angle, right?
It is. Data privacy, regulation, sovereignty. It's all paramount now. CEOs are realizing they don't want their proprietary formulas leaving their four walls to train a public model that might help their competitors.
And if Arvind is right...
If he's right, and half the AI market stays on-prem, IBM is arguably the best positioned company in the world to capture that spend. They are the fortress for private data.
So you have the software flying, the hardware surging. Let's talk about the buzzword of the decade, AI. Deep Dive Part 3. The $12.5 billion number.
The Gen AI book of business.
Right. They reported that their cumulative Gen AI book of business now stands at over $12.5 billion.
And the split is roughly, what, $2 billion in software and $10.5 billion in consulting.
That's it. But interestingly, they said this is the last quarter they are going to report this metric. Does that worry you? Usually when companies stop reporting a number, it's because it's about to get bad.
You know, in this case, I actually think it's a sign of maturity. They're saying AI is now so embedded across the business that breaking it out doesn't make sense anymore.
It's just business now.
It's just business. It's like how companies stopped reporting internet revenue in the early 2000s. Eventually, all revenue was internet revenue.
Fair point. But let's talk about that consulting number. Revenue was only up 1% in constant currency. That seems like the weak link in the chain here.
It is the lagging sector, certainly, but you have to look at the backlog.
Which is growing.
It's up 2% to $32 billion. The narrative here is that the market is shifting from experimentation to scaling. Last year, companies were just playing with chatbots.
Look, it can write a poem.
Exactly. Now, they're trying to integrate AI into complex supply chain workflows. That takes more time to sign and deliver.
So the sales cycle is longer because the projects are harder.
Precisely. And despite the slow top-line growth, look at the profitability. Consulting margins expanded by 180 basis points.
That is significant.
It tells you they're shedding low-value work, they're getting out of the low-margin lift and shift business and replacing it with high-value AI strategy work. So they're doing less, but making more on what they do.
Okay, moving on to the future. Deep Dive Part 4. 2026 Guidance and the Confluent Acquisition.
The outlook was actually quite constructive.
I thought so too. They are guiding for revenue growth greater than 5% in constant currency, and for free cash flow, they expect about $15.7 billion.
That's another $1 billion on top of the record year they just had. And software is guided to grow around 10%.
That's the confidence signal. If they thought the software growth was a fluke, they wouldn't guide double digits for next year.
No way.
They also talked a lot about the Confluent acquisition. They expect to close that by mid-2026. Now, for those who don't know, Confluent is all about data streaming.
It's the plumbing that moves data around in real time. But usually when you buy a high-growth tech firm like that, it hits your earnings per share immediately.
Because you absorb all their losses and stock-based comp.
Right.
And management was transparent. They expect to absorb about $600 million of dilution from Confluent in 2026. But here is the magic trick IBM is pulling off.
They claim they can pay for it.
With productivity.
This is the part that I found most fascinating. This is the Project Bob discussion.
Project Bob. It sounds so harmless, but it's actually their secret weapon. Tell us about this.
So they mentioned they achieved $4.5 billion in run rate savings exiting 2025. But they expect another $1 billion in savings in 2026.
And Project Bob is how?
It's their next-gen AI software development system. They have 20,000 IBMers using it, and they are reporting productivity gains averaging 45%.
Hold on. 45% productivity gains for 20,000 developers. That is insane leverage.
It is. It means a developer can do nearly 1.5 times the work they used to do. This allows IBM to essentially use AI to automate their own workforce. It frees up cash.
And what do they do with that cash? They buy growth assets like Confluent.
Exactly. They cut costs through AI, buy a high-growth asset, and the EPS stays steady or grows. That is sophisticated financial management.
It's a self-funding transformation. They're using AI on themselves to afford to buy more AI companies to sell to you.
That is a flywheel if I've ever heard one.
Right, to bring it all together for the investor context. So what? The stock's at $314. The narrative has shifted.
The narrative is durable incumbent. In a world where tech trends are so volatile, I mean, one day the metaverse is hot, the next day it's dead, IBM offers stability.
They're giving you 5% top-line growth, but backing it with $15 billion in cash flow.
That funds the dividend, it funds M&A, and it funds buybacks.
And the macro link is clear. Enterprise spend is selective. Companies aren't just throwing money at everything.
But they must spend on modernization. They can't run a bank on 1980s code forever. IBM captures that spend. They're the safe pair of hands for the hybrid world.
There is a risk factor we should mention, though. We can't just be purely bullish. The CEO noted the memory tax.
Right. This is about DRAM prices.
Specifically high bandwidth memory, or HBM.
Because everyone is building AI chips, the demand for HBM is through the roof. And the CEO noted that DRAM prices are 6 times higher because of this.
That's a massive input cost increase that could pressure hardware margins later in the year.
Correct. Right now, the volume of Z17 sales is so high, it's offsetting the cost. But if sales slow down even a little bit, that high memory cost is going to eat into profits. It's something to watch.
Absolutely. Okay, let's get to the fun part, the segment everyone waits for. Please remember, this is for entertainment purposes only.
We are just two voices on a podcast. We are not your financial advisor.
This is not financial advice.
Do not mortgage your house based on what we say next. Please do your own due diligence.
But if you were a hedge fund analyst pitching to an investment committee right now, what is the trade? I'm calling this one the sovereign fortress pair trade.
I like it. Sounds defensive but aggressive. What's the structure?
It's a play on Arvind Krishna's 50% of AI stays private thesis. The trade is long IBM.
Okay.
You are buying the fortress of on-premise data, the Z17 cycle, the private AI inferencing engine, and you go short forth, a pure play, lift and shift, cloud consultant.
So you find a firm that relies 100% on the narrative that everything is moving to the public cloud.
Exactly. A consultant that has no proprietary software, no hardware, just bodies moving data to AWS. You short them.
That is spicy. You're betting that the migration to the cloud trend has hit a plateau and that hybrid is the permanent state of reality.
If data sovereignty laws get stricter, or if companies get spooked by data leaks, that pair trade prints money. The consultant gets squeezed, IBM benefits.
I like it.
And if you want a wilder idea, a more degenerate idea, I'm looking at the Z-cycle gamma squeeze.
Oh boy. Here we go.
Hear me out. Wall Street models for mainframe cycles are outdated. They assume a sharp drop-off after 3 quarters.
Because that's what always used to happen.
But this cycle is different because of the AI on chip use case. Clients aren't just upgrading, they're expanding capacity. So the tail of the Z17 cycle is going to be longer and fatter than models predict.
So you buy short-dated calls targeting the next 2 quarters. You are betting that the revenue deceleration the street expects just doesn't happen.
Precisely. You catch the analysts offside. When the infrastructure number comes in flat or even up instead of down, the market panics, market makers have to hedge, and you get a gamma squeeze.
It's aggressive. It relies entirely on that AI use case being real. But given the 67% growth in Z revenue this quarter, it's not impossible.
And that is why we are talk tickers. We look for the edge.
Indeed.
Let's wrap this up. IBM delivered a double beat. Revenue up, EPS up, margins at historic highs, free cash flow at a decade high.
And they have a roadmap to over $15 billion in cash in 2026. The pivot to software isn't a slide in a deck anymore.
It's $9 billion a quarter in the bank.
The question for you, the listener, is simple. Do you believe the thesis? Is the future of AI hybrid and private? Or is the public cloud going to eat everything eventually?
IBM has staked its entire future on the former. And right now, at $314 a share, the market is voting with them.
The market believes.
We will be watching to see if they can hold it. Until next time, keep your eyes on the ticker.
See you next quarter.